Every crisis in the modern era has one common ending. When markets fall, when credit freezes, when governments struggle to respond, the institution everyone turns to isn't Parliament, or the Treasury, or the voters. It's the central bank. The United States has the Federal Reserve. Europe has the European Central Bank. Japan has the Bank of Japan. Nearly every country has its own version. They vary in size, mandate, and influence, but today they share one undeniable role. They sit at the center of the global financial system. But here's the paradox. These institutions were never designed to rule the economy. They were created to stabilize it. Yet over time, they became the most powerful actors within it. How did organizations built to manage currency turn into the primary authorities that decide the cost of money, the direction of markets, and the fate of entire financial systems? This is The Financial Historian, where money, power, and history collide. And in this story, the rise of central banks is not a tale of conspiracy, but of evolution, driven by crises, shaped by necessity, and amplified by the world's increasing dependence on credit. To understand how central banks took over the modern world, we need to rewind centuries back to a time when money itself was physical gold, silver, copper. Value was weight, and weight was trust. The problem was simple. Metal was scarce, but state expenses were not. Wars expanded, trade networks grew, and economies demanded liquidity that mines could not supply. Monarchs needed financing, merchants needed stability, and lenders needed guarantees. It was in this environment that an idea emerged, an institution that could hold reserves, issue notes, manage government borrowing, and provide credibility where none existed. In 1694, the Bank of England was created to finance a war, but it introduced something larger, a permanent money manager for the state. Other nations rushed to replicate the model. France established its own versions. The Netherlands refined the practice. And more than a century later, a young United States founded the Federal Reserve System to stabilize a fragmented banking network. Vulnerable to panics, central banking began as a solution to volatility. But it was crisis after crisis that expanded their reach. Fast forward to the 20th century, and the world no longer resembled the simple metal-based economies of the past. Industrialization accelerated. Global trade exploded. Nations borrowed to build, to fight, to recover, and to grow. The gold standard began to strain under the pressure. It limited how much money could circulate, how much governments could spend, and how quickly economies could respond to shocks. The Great Depression pushed the old system beyond its limits. Banks collapsed, credit disappeared, and unemployment rose across continents. Gold failed to provide stability. In response, governments granted their central banks new tools: control over interest rates, open market operations, and emergency lending powers. Monetary policy became a steering wheel for national economies. The institutions created to stabilize currency now had the authority to influence employment, investment, and economic growth. The ground shifted, and central banks stepped fully into the spotlight. The next turning point came after World War II. In 1944, at Bretton Woods, the United States dollar became the world's reserve currency. The Federal Reserve was no longer just an American institution. Its decisions had global implications. Europe rebuilt its economies around central banking frameworks. Japan did the same. Over time, nearly every government formalized the role of its central bank in managing national money supply and supervising financial institutions. For a brief period, currencies were still tied to gold through the dollar. But in 1971, when the United States ended convertibility, the last link between money and metal disappeared. From that moment on, currency became entirely abstract, no longer backed by gold, but by the policies, credibility, and judgment of central banks themselves. Money became a system of trust, and the custodians of that trust were the central banks. Their influence grew in proportion to the scale and complexity of the monetary system they oversaw. Then came 2008. The global financial crisis was a stress test unlike any before it. Major banks faltered, mortgage markets collapsed, credit froze, governments responded, but fiscal policy moved slowly. The speed and scale of the emergency required immediate intervention, and central banks provided it. The Federal Reserve, the European Central Bank, and others launched unprecedented programs. They purchased government bonds. They purchased private assets. They lowered interest rates to near zero. They injected liquidity directly into the financial system. The actions were controversial, but the results were clear. Central banks had become the institutions capable of preventing systemic collapse. Their balance sheets ballooned into the trillions. Their decisions determined market expectations. Their role expanded from managing currency to stabilizing entire financial ecosystems. The 2010s reinforced the trend. Economies recovered, but relied increasingly on low interest rates and large-scale asset purchases. Countries like Japan maintained near zero or negative rates for years. Europe followed similar strategies. Investors began to watch central bank press conferences the way previous generations watched election results. A single sentence could move billions of dollars across markets. Every bond, stock, and currency was priced through the lens of central bank policy. The institutions once created to operate quietly behind the scenes had become the primary drivers of global financial conditions. And then, in 2020, another shock arrived. The pandemic shut down economies almost overnight. Demand collapsed, supply chains fractured, and uncertainty spread worldwide. Once again, governments responded, but once again, central banks acted faster. They launched emergency lending facilities, expanded asset purchases, and ensured markets continued functioning even as much of the real economy paused. Trillions of dollars, euros, and yen were created to stabilize the system. This period marked one of the largest monetary interventions in history, and with it, the role of central banks grew even larger. Their decisions affected not only financial markets, but also corporate survival, household borrowing costs, and global capital flows. Today, central banks influence nearly every corner of the world economy. They set the interest rates that determine the cost of mortgages, business loans, and government borrowing. They manage inflation expectations. They act as lenders of last resort to the banking system. They purchase assets that shape financial conditions. They oversee regulations that govern stability. And because money is now fundamentally credit, and credit depends on trust, the credibility of central banks forms the backbone of the entire monetary system. Nations rely on them for stability, markets rely on them for signals. And in times of crisis, their role becomes indispensable. But this rise comes with a new reality. When institutions become central to stability, they also become central to responsibility. Central banks do not control governments, but they operate beside them. They do not direct markets, but their decisions influence them. They do not manage the global economy, but their policies shape its environment. They occupy a unique space, neither fully political nor fully independent of political consequences. Their power emerged not from conquest or design, but from the demands of an increasingly interconnected financial world that required rapid responses, steady guidance, and consistent frameworks. The result is the system we live in today, a world where money is created through credit, where the stability of currencies depends on expectations, where the cost of borrowing affects everything from housing to investment, and where central banks, once narrow institutions managing reserves and issuing notes, now guide the conditions under which the global economy operates. They did not set out to take over the modern world, but as each crisis reshaped financial systems, their responsibilities expanded. As economies grew more complex, the need for coordinated monetary policy deepened. And as trust shifted from metal to institutions, their influence became foundational. Understanding their rise is essential to understanding the modern economic landscape. Because behind every interest rate decision, every bond purchase, every liquidity program, and every intervention lies a simple reality. Money today is not just a medium of exchange. It is a structure built on confidence. And central banks are the architects maintaining that structure. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.